Okay, so hello, my name is Marco. I'm going to be talking about Anthony and Sarah Benson for the Model 1 presentation. Um, presentation case. Well, let's start from the relevant facts. Um, Anthony is 65 years old. Outside of his marriage with Tara, he wants to take care of Edmund, probably one of his favorite nephew. He's disabled and he's gonna need financial help in the future. Tara is 50 years old, and outside of her marriage with Anthony, she had Peyton, 30-year-old daughter. She's completely dependent. However, she's had some problem with spending too much money, and accumulating debts. Um, and she also has Marlene, her 71 years old mom, which is in extreme poor health, and um, as a will and estate is leaving everything to Tara. They've been married for 25 years. They have three children: Nicole, 23 years old; Ryan, 21 years old; Danielle, 5 years old. The retirement plan is Anthony is want to sell his business and retire this year, and at the same time he wants to keep pass down health to his children along to avoid death taxes. Tara, she would like to retire this year as well, if it's possible. However, she doesn't mind working 5 more years, or she also has the possibility of working two-thirds of the time and still continue her benefits. Two-thirds of the time till retirement, obviously. Um, for what related to education, Nicole and Ryan are already attending college, and their tuitions are paid through savings accounts. However, they have concerns for Danielle because she's only 5 years old. So, with them going to retirement now, they will need to start saving for money for her because obviously the income is gonna stop. The salary income is gonna stop, and they're gonna have to save some money for education. Now, let's talk about strengths and weaknesses. Well, let's start from the financial situation. The statement of cash flow totaling for after you know the total inflow is $356,600. The total outflows is $319,991 for a cash surplus of $36,609. The statement of financial position states that the total assets is $7,700,664,200. For a total liabilities are very low, is only $245,000, and for a huge net worth of $7,519,200. Now, if we go more in depth in this in their financial situation and we calculate some financial ratios, we're gonna find out that they have more strengths than weaknesses, especially. Okay, let's get into it. Strength with liquid assets, they can afford to pay monthly expenses for 42.2 months. They also can afford to pay current debt payments for 93 years. 96% of their assets is owned, and only 3.50% of what they own are liabilities. Housing and monthly debt payments are covered using 9.5% of monthly gross income. Usually, a good situation is you want to keep this below 36%, so they're doing very good on this side. Same for housing costs, which take up to 6.16% of monthly gross income. The standard is 25%, below 25%. Moreover, the gross income can be replaced by investment assets for 14.57 years. However, in my opinion, there are some weaknesses. The total debt take up to 68.7% of annual income is not that bad, but it would be better if it was lower. Also, the monthly savings to monthly income ratio is 15.8%, and the standard is just 15, so they're just above the standard. On the side, you can see the ratios that I've calculated to find out these numbers. Um, Moreover, let me talk about the government agencies that oversee their plans. Well, there's IRS, or Internal Revenue Service, that supervises the creation of new retirement plans and monitor and audit the operation of existing plans, interpret the federal legislation, administer qualified plan system, and administer qualified plan system. The Employee Retirement Income Security Act, also called ERISA, also known as ERISA, is a federal law established in 1974 and established requirement for benefit plans such as coverage, participation, vesting, reporting, and disclosure fiduciary requirements. Then there's the Department of Labor, which ensures compliance with ERISA's plans, reporting, and disclosure rules, and oversees compliance with the prohibited transaction rules. Lastly, the Pension Benefit Guarantee Corporation, which is responsible for ensuring vested plan participant against loss of benefits from plan termination. Moving forward, let's look at Anthony and Tara. What type of plan? Sorry, what type of pension plans exist? There's qualified plans which meet the requirements of Section 41A and ERISA. The major benefits of qualified plans are they are immediate deductible of contribution for an employer, and the employee is not currently taxed on plan contribution and earnings. They're tax advantage plans that do not meet all qualified plan requirements but operate very similar to a qualified plan, and non-qualified plans which they don't need to comply with requirements of Section 408 and most requirements, and they have advantages that can discriminate in favor of highly compensated employees or key employees. The funding may be deferred, which means promised now but paid later. Now, if you look into the client situation, Anthony has a profit sharing plan, which is a qualified plan, a money purchase pension plan, which is a qualified plan, and a traditional IRA, which is tax advantage plan. Terra has a section for 1K and a defined benefit plan, which are both qualified plans. The taxation and contribution, the portfolio growth is not taxed, and the distribution is taxed as ordinary income. Now, which who of them can be considered a highly compensated employee? Only Anthony can be considered a highly compensated employee of his plan because the salary is higher than 130,000, is 250,000, and the ownership is about 5%. Obviously, he owned the place. Tara is not a highly compensated employee because she doesn't make enough and she doesn't have ownership. Now there was a question. There was a scenario which is if none of the other 25 employees at Anthony company makes 130,000 or more, is ratio test satisfied? Yes, it is satisfied because for the ratio test to be satisfied, 7% or more of the employees has to contribute, therefore make less than 130,000. 7% of 25 is 18 employees. In this case, all 25 make less, so the ratio is definitely satisfied. Now, let's talk about vesting schedule. Tara has a current vesting schedule of 2 to 6 years. What does that mean? It means that when she's contributing for a plan, if eventually she wants to leave and she can grab her own money, she can always grab her own money that she contributed to the plan and put in maybe another plan like a traditional IRA or a Roth IRA. However, to be able to have access to the employer contribution, she has to wait at least 2 years, and at that point she'll be able to take with her 20% of the employer contribution. To get the whole 100%, according to the schedule as on the slide, she has to wait 6 years or more. Um, Now, in a 3 to 7 year schedule, this is how it will be. The schedule would just change, which is it add one extra. It is a little bit like takes a little bit longer time. However, cliff vesting is another type of schedule. We can it's basically is no vesting is required before 5 years of employee service, which means you're not gonna have access to any vesting till you hit 5 years. However, once you hit the 5 year mark, you'll have 100% vesting. Um, this is a tactic used by employer to avoid employee turnover ratio, because a lot of people work for somebody, and as soon as they hit 2 years, they can take some money, so they leave. That way, they have to wait 5 years. Okay, lastly, how much Anthony can contribute to his plan, and how he can benefit from social security integration. Um, to prevent a qualified plan from being used primarily as a tax shelter for highly compensated employees and executives, the tax code imposed a limitation on plan benefit contribution. For 2020, it was 57,000 annually. However, Anthony, so he can contribute up to 57,000, but he also can make a catch-up contribution of $6,500 for a total of $63,500 contribution. That's his limit. However, he can benefit from a Social Security integration. Social Security stops retirement preparation at a taxable wage base of $137,700 in 2020, which leaves a gap from that can be filled with a Social Security integration. Basically, um, say how if the base contribution percentage for the defined contribution plan is 5%, the permitted disparity is also 5%, making the excess percentage equal to no more than 10%, 5% plus 5% of compensation above the integration level. However, in other words, to make it sound a little bit easier, to fill part of the gap from 137,700 to 150,000 $250,000, Anthony can contribute 5% for his employees, for each one of them. So he can contribute, and because of that, he can contribute 5% to himself for each employee he contributed for a total of 10%. So that can help him, fill that gap. And that's it.